Bismillah ar-Rahman ar-Rahim. Good evening, everyone, and welcome to this webinar tonight. The objective of this session is to help you gain basic knowledge about trading on Qatar Stock Exchange. Of course, I'm not promising that you can learn years of stock picking and market timing experience in one night. However, I can guarantee you that it's not rocket science. Everyone can do well in the stock market. But before that, we need first to know that stock markets are volatile. Stock prices are always going up and down, and this is very common in stock exchanges. Therefore, we need also to understand that we should have the emotional strength and the patience to stand the volatility of the market. No one says it better than Peter Lynch, one of the most successful fund managers in the 90s, when he said, the key organ here is not the brain, it's the stomach. Also, one of the most successful businessmen, his name is Charlie Munger, as I recall, has once said, you don't make money when you buy, and you don't make money when you sell, you make money when you wait. So patience is a key virtue for successful investors. Additionally, to pick the right stock, you need, as a first step, to create your own story. And this can happen easily by the direct experience that you might have with companies in your town or neighborhood as a consumer, for example. Let's see here in Doha, for example, let's take Elmira as an example, Wuqud, any of the banks around us, Ayam Bank, QNB, or whatever. And ask myself, what's my personal experience with the services and goods? What's the overall quality when I deal with them? Are they expanding over time? Are they having more branches over time? Is it always busy when I visit, like in Mira, for example? Is it always busy when I visit them? Means that there is high demand on their products, and so on. Peter Lynch also said that one of his fund's most successful investment decisions was to invest in the stocks of the Swedish car Volvo. He said this started by buying a Volvo car. It was better and safer than its American rivals. He then did a little bit of research and found that the company stock was selling equal to its cash, means that you are paying almost nothing for the company. Consequently, he decided to buy its shares. So buying the car actually turned out to be a great way to begin researching the stock and making one of his best investment decisions ever. Another example, a very famous example in the stock exchanges world, back in the 1950s, a fireman from New England noticed that the factory in his neighborhood seemed to be hiring and expanding all of the time. This person didn't have a MacBook or smartphone to run technical analysis models at the time, of course. He wasn't a professional investor. He was just a good observant. So he decided to put $2,000, I guess at the time, per year into this company's shares. By 1972, like in less than 20 years, the fireman became a millionaire. So tonight we will discuss together some important investing and trading concepts. But before that, please allow me to give you a brief historical background about QSE, which was established in 1995 and started operations in May 1997. Since then, QSE strives to become a world-class exchange and actually has passed many milestones in its way of development, such as the increase of listed companies from 17 companies back in 1997 to 47 companies right now, plus 2 ETFs, exchange traded funds, and several governmental bonds and treasuries. Accordingly, the market capitalization has grown by more than 80-fold, from 6 billion Qatar riyals in 1997 to about 480 billion as almost end of today. This qualifies us, by the way, to be the second largest exchange in the region in terms of market capitalization. QSE witnessed also a huge achievement in 2013 by being upgraded by the world-class index MSCI from frontier to emerging market status, which put QSE on the radar of the biggest global investment funds and increased the inflows into the market. As I mentioned in the beginning, this webinar, I want to make it more interactive and more fun than the previous one. So I'm preparing 5 polls for you to gather the answers. So I will launch the poll after discussing each topic that we have today, and gather your answers. By the way, the answers, there is no right, wrong answer. It's just kind of gathering your opinions and feedback. And then I will share the results. Of course, this will be anonymous results, just by percentage, to see how you, what is the feedback of your on the topic that we discussed. And then if any one of you wants to discuss, to speak about the results or about the topic in 30 seconds or so, please raise your hand. There is a button down here, raise hand. So if you click on that button, I will see you here that you raised your hand. I will pick you and give you the option to speak. Of course, speaking, your video will not be appearing, only your voice. So we will hear you, everyone will hear you, and let's get your opinions and feedback by voice also. And if you have anything you want as we go, you want to, any feedback you want to put, please put it on the chat. If you have questions, put it on the question and answer section, and we answer it by the end of the session, inshallah. So please let me share my screen for the presentation. So tonight we will discuss what are the main reasons to invest, advantages of investing in the stock market, because as you know, of course, there are so many vehicles, investment vehicles. There is real estate, there is gold, and others. But what are the advantages of investing in the stock market? What are the types of securities listed on the stock exchange? Some market ratios, let's discuss some market ratios which is important that we know about and look at them before taking our investment decision. What is the risk in finance and how we can mitigate this risk. And then we'll speak about the account opening procedures in QSE, the trading session, trading orders, and so on. So what are the main reasons to invest? If you Google it, if you put in Google what are the reasons to invest, you might find an article says the top 10 reasons, top 5, top 15, whatever. So, but in my opinion, these are the most important 4 reasons to invest. First, the wealth creation. So, of course, when we invest, we need to increase our wealth. And investing offer returns on investment plus price appreciation over time. And this helps you to increase your wealth on the long term. Also, the second main reason is to reach financial goals. Every one of us has their financial goal. I want to buy a house. Someone else, my friend, wants to buy a bigger car. My son wants to start his own business as an entrepreneur, and so on and so forth. So by investing and having returns on this investment, you can reach and achieve your financial goal. Also securing our future. If you are young, you need to secure your future against any uncertain situation and circumstances. If you are old like me, you want to save for retirement. So also securing future is very important reason to invest. And the fourth one, which is I believe is very important, and I call it charity ability. So investing my money, this will give me returns and extra money, so I can use it to help others also. And helping others, supporting others will give us or make us feel better and more satisfied, of course. So what is an investment in the stock exchange? An investment in the stock exchange is a financial security, financial asset. Sometimes they call it financial asset, both with the objective that this security will offer returns over time, so regular returns, and we call it dividends. And these dividends can be cash, in form of cash, or in the form of the security itself, free. So sometimes companies, they give you stock dividends. So they give you more shares in the company without paying anything. So you take free shares or bonus shares, as we call it here in Qatar. Also, you want to be able to sell this financial security in the future at a greater price for profit, and this is called capital gain. So let's take the first poll tonight about this. So our first poll here, I will launch it. Why do you invest? Why do you want to invest? You choose one or more, and you can choose more than one because this is a multiple choice. So you can have more than one. It's not only single choice. People are answering. So we have now 52 answers out of 74 attending session. So let's wait like 10 more seconds and we end the poll. Okay. So now we have 60 answers, 62, good. Let me end the poll and see the results. Here are the results. Look at the results. Here we have the four reasons: wealth creation, reach financial goals, secure your future, and support others. So the highest score is for secure your future, 68%. And then followed by wealth creation, 65%. Then reach financial goals comes in the third place by 60%. And last but certainly not least, support others, 37%. So let me now see if any one of you wants to discuss this more. Please do raise your hand and let's hear what do you think about the reasons of investment. Are those reasons the main reasons, or there are more reasons than that in your opinion? What do you think? I cannot see any hands raised. So please, we want to make it more fun. Khalid raised hand. Okay, I will take Khalid, the first one who raised his hand. So let me check here. Yes, Khalid. Okay, Khalid, I will give you now the option to speak.
السلام عليكم أستاذ سامر.
أهلا وسهلا خالد.
The reason why I'm investing is that I want to, instead of leaving the money in my account, it's much better to actually let it work in the market, because it will incentivize, like the market. It will provide liquidity to the stocks. It's much better than putting it in the bank, where I get, like 1%, 2% every year. It's much better to let the money become more liquid in the market, in the Qatari market. That's the reason why I'm investing.
Very good, Wallahi Khalid, very good intention from your side. And also, in return, you will grow your money on the other side. When you invest, but also, yes, this is very good intention from your side, that you want the money to be going in the market, and everyone will benefit from that. Because of course, when the money is invested, or people invest their money, this will make the economy grow better than if I have my money and put it in home without using it, no spending, no investing. Of course, it will shrink the economy. Anyone else wants to speak? Okay, so let's move to the other topics, and then we can. Okay, so let me stop sharing this one. So, and then, okay. So as I mentioned, the first important thing when we think about investing is that we want to have return on our investment. And this helps us to create or increase our wealth. And this increase or this return on investment, of course, can be in two forms. Both of them, one of them, but I mean, these are the main two forms of returns. The capital gain, or the increase in the price of the asset that I buy. So I buy a share today at 5 Qatar riyals, maybe after 5 years it will be 25 Qatar riyals. I sell it at 25, so I make 20 riyals profit, and this we call it capital gain, and also the dividends. So when you invest in a company and become or buy the share of a company, you become a shareholder, and you can get sorry, let me. And you can get part of their profit every year as an owner of this company, of course. So, and this is what we call it dividends. And the dividends can take both forms, cash form or stock form. But the interesting thing here, and what is very important that you need to know, here is, this is the chart for the QE index since 2010, for 10 years. The burgundy color is the QE general index, and this orange color is for the QE total return index, yani the increase in the prices plus the dividends. Here is only the index for the prices. So, but both of them, if we look, we will find that over the long term, always there is an uptrend. See, as I told you, there are ups and downs on a daily basis. This is what we call it volatility, and all stock markets are volatile, and this is common for all stock markets. You know, if the stock market become flat, then it will be dead. Like, you know, the line cannot be flat. It should always go up and down for the index and even for the stock prices. So, but the thing is that smart investor or the intelligent investor, as Benjamin Graham in his very famous book said, it's not a matter of looking at the daily ups and downs. It is more important for the investor is to look at the trend. So if we look here at the 5 years trend, for example, almost 5-year trend, we'll find that it's an uptrend. Also for the 10-year trend, it's also an uptrend. So as I mentioned in the beginning, it's important to, because markets are very volatile, they can go down and they might crash even. And you need to have the emotional strength to stand out this volatility and crashes. And this will happen on the long term. So if your time horizon is 1 or 2 years, I don't think stocks is the right choice for you to invest in. Here also there is a famous example. You see this boy is climbing the stairs and playing with the yo-yo. So they say, please don't look or focus on the yo-yo movements, ups and downs, which is the daily movement in the market, but always look at that trend, at the destination of this boy that is always going up. Then let's move to the second advantage of the stock exchange over other types of investments: liquidity. So stock markets provide investors with the ability or easiness to buy and or sell stocks on a timely basis without affecting prices. So it's easy in the stock market to transfer your cash into assets, into shares, for example, and also it's easy to transfer your shares by selling them into cash. And here the liquidity means what? Means that you can do this process easily, quickly, with lower spreads, I mean without big effects on the market price. If we compare this, for example, with the real estate market, if I have a nice house and I want to sell it, for example, it's not easy, by the way. It will take longer. It will take a long time in order to sell it with the price that I want to sell at. Yes, maybe I will sell it quickly, but I will lose because I will have to decrease my price in order to attract investors to buy this house. Or if I want to sell it at a nice price, a good price, I need to wait. So it's not very much liquid like the stock market. You have the trading session running every day from 9 a.m. Until 1:15 a.m. During this trading session, you can buy or sell stocks continuously. Also, diversification. The stock exchange offers you or provides investors with the ability to diversify their investments. Diversification is a very important concept, as we will see later about to mitigate risk, to help us, because there is a very famous saying, and I believe it was coined by the author of Don Quixote, when he said, don't put all the eggs in the one basket. And the stock exchange help you to do so. So you can diversify your investment. You can buy more than one company and have a portfolio. So if one company performs bad, other companies, maybe they perform well and compensate the bad performance of the first company. And even you can diversify not only between companies, but also between sectors. Here we have 47 listed stocks distributed over 7 sectors that representing the Qatari economy. Also price discovery. Stock exchanges gives you the ability to discover the price. Every day and every minute I can know how much is the market value of or the market price of my stocks. This is not easy for real estate, for example. If I have a house, again, and I want to know today what's the market price of my house, it's not easy. Even I cannot compare it with my neighbor's house who sold his house yesterday, for example. Maybe he was lucky to sell it at a high price, but this is not the case for my house and so on. But for stock exchanges, as long as there is always interaction between the supply and demand in the market, there is always a price discovery. But the thing is that I want to refer to, which is very important here, like what Warren Buffett said, price is what you pay, but value is what you get. So we have always to differentiate between price and value. So we might have a market price for a stock, but this stock is traded under value, or this stock is traded over value. This is very important when we start our process of stock picking and market timing, that we should always try to find the stocks with a price which is under its real value. And we will see how, or maybe in the financial analysis sessions that we will have this week and next week, inshallah, if you attend, you will get more insights about valuation. What are the types of securities listed on the stock exchange? We can divide the securities into 2 main types: equity securities and debt securities. From the name, equity, when you have an equity security like shares or stocks, we can use both of them interchangeably. This means that you own part of the company. But for debt securities like bonds, this means that you lend the company. You are a creditor to the company. You are not an owner. And this is very important difference when we differentiate between these types of securities in terms of risk, in terms of rights, and so on, as we will see in the coming couple of slides. So stocks or shares, the capital of any company is formed of shares. A share is a unit of ownership in a company. So if a company has, like, for example, 10,000 shares, and you own 100 shares, of this share capital of the company, this means that you own 1% of this company. And this 1% entitle you, this ownership, excuse me, in the company's shares entitle you to some rights. Like you have, or you are entitled to get a share of the company's profit, which we call it, as we said, dividends. Every year, the company, after publishing their financial statements, the board of directors make a recommendation regarding profit distribution among the shareholders. Then they have an AGM, or annual general assembly meeting. All shareholders have the right, again, to attend this meeting, and they have voting rights. They have to, they have the right to vote on the board of directors decisions or recommendations, and of course they can say, yes, this recommendation of distributing profit is good, is not good, please increase, please decrease. This is all part of the shareholders' right. Also, as a shareholder, you have a limited liability investment scheme. What does it mean? It means that if I'm a partner in a partnership company, I am responsible for the company. So if the company is, or the company goes bankrupt, and the creditors to the company, they want their money back, and the assets of the company is not enough, they can claim on your personal property as a partner in a partnership companies. But here in shareholder companies, no. The maximum loss that you can have, or the maximum risk, is limited only to the amount of shares that you have. No one can claim on your personal properties. The second type of securities in the market is the bonds or treasury bills. These bonds is a type of debt on the company. So bonds can be issued by the government, like the case of the bonds and the treasury bills listed now in the stock exchange, or can be issued by companies. And I believe we don't have until now bonds listed on the stock exchange, but maybe in the future we will have some bonds. And if it is issued by a Sharia compliant bank, for example, a Sharia compliant company, they call it sukuk. The idea is the same, that if you own a bond, you are not an owner of the company. And this, of course, makes a big difference. Like if you own a share in the company and you are a shareholder, you are entitled to part of the profits only if the company realizes profit by the end of the year. But as a bondholder, you are entitled to the interest on this bond regardless the company makes profit or losses. The other thing, that as a bondholder, you are not entitled, you cannot attend the General Assembly meeting, for example. You cannot discuss with the management of the company during the meeting any of their decisions or the performance during the year. You only have the right to get your interest, and that's it. One other major reason also, that for the shareholder, if you want to exit your investment, you sell the share in the market. You cannot go to the company and tell them, give me the value of my share. But in bonds, each bond is issued with a maturity date. Like the loan should have a period of time, should have an age. So if the bond maturity is 3 years, for example, this means that during the 3 years, the company will pay interest to the bondholder, and by the end of the 3rd year, they will return back what the investor paid in the first place when he bought the bond. And of course, if the bond is listed in the stock exchange, then also the bondholder can at any time sell this bond on the stock exchange. So let's have another poll here. Let's look at example first, and then have poll number 2 about the types of securities. So let me share now another file with you to look at the example on Excel sheet. Let us look at this example. We have company, we have company A and we have company B. So we have two companies. Both of them, they are very well established companies. They are listed on the stock market. Company A share capital is 1 million Qatar Riyal. So their capital is 1 million Qatar Riyal. Company B is 2 million Qatar Riyal. The par value, which is the initial value by which the share is issued to the public, is 1 Qatar Riyal for both companies. And by the way, this is fixed across the board of all listed companies in Qatar Stock Exchange. It used to be 2 years back 10 riyals, but we did what we call it stock split, and now it's 1 riyal for all listed companies, and this value is fixed over the life of the company. It doesn't change. And then we have, this means that the number of shares for company is 1 million shares, number of shares for company B is 2 million shares. We have a market price of company A 10, and company B has a market price of 8. Both of them, they want to or need funds to finance future expansion. So company A decided to get these funds through issuing more shares, new shares for the existing shareholders. And company B, they decided to get this finance by issuing bonds. So here they are issuing equity, more equity, and here they are issuing debt. They don't want to have more shareholders into the company, for example. So here, the new required shares to be issued is 100,000 shares, because they will issue the share at 1 riyal as a par value, but because the market price of the share now is 10, they can add to this value, the 1 riyal, they can add a certain price, we call it premium, and issue the share with 5 riyals. So the shareholder or the existing shareholder will be happy. He will be subscribing in the new shares, buying new shares of the same company by 5 riyals each, and at the same time, the market price of this share is 10 riyals. So this is a good privilege for the existing shareholder, and at the same time, the company will be able to raise the funds that they want. And here, company B decided to issue bonds. They decided to issue 10,000, the number of bonds that will be issued, 10,000. The face value of each bond is 100 riyal. The maturity of the bonds, 5 years. This means that the loan is 5 years. So if you buy the bond, you will pay today the face value and get or return back what you paid after the end of the 5 years. Every year, you will get an interest rate of 3% out of the face value, which means 3 riyals. The annual interest that the company pay, regardless their performance, whether it is profit or loss, they will have to pay 30,000 Qatari riyals as a total for all the bond holders, and the total amount is 1 million. Number of shares, of course, is not changed. Now you can realize something, that of course bonds as an investment vehicle is less risky than shares, because when you buy shares, you are uncertain about the outcome of the company by the end of year, for example. Is it profit? Is it losses? There is an element of uncertainty. But in bonds, you are certain that by the end of the year, you will get 3% as an interest rate, regardless the performance of the company. So let's run the second poll now. And see what's your preference regarding investment options. Here, poll number 2 says, option 1, you invest 1,000 Qatar riyals in shares of company A. at 5 riyal per share, as we, with 50% probability of 6% net profit, or you invest 1,000 Qatar riyal in bonds of company B at 100 riyals per bond with 100% probability of 3% net profit. You choose. Okay, so let's share the results now. We have a majority for option 1, company A shares, 59%, and 41% opted to buy the bonds. So this is, of course, something depending on the risk profile of each of us. If I'm a risk-averse person, of course, I will go to the bonds option because I don't want, I don't like to bear risk. But for risk-tolerant people, they can go and buy shares and they feel that the risk is fun. At the end of the day, what is more important here to understand also that as a finance concept, we say that the more the risk, the more the expected return. No pain, no gain. So let me take some chats here and then see who wants to also give more feedback about this point. Dr. Ano says, as a master of my money, I want it to work for me. When I work for it and make and keep it, I make it an idle asset, so I invest. So this was like a reason of investment. Salah says here, if you see the trend from 2014 till date, then it is either flat or downwards trend, which means there has been a downward trend in last 6 years. Is this correct? I cannot recall it now, Salah, but let's see this on the charts on our website. I will open the website in the coming few minutes and see together. Can a company, Ms. Aisha says, can a company have a market price less than the par value share? Said, yes, yes. We have few companies with a market price less than the par value. Yeah, it is. Because at the end of the day, the market price is the interaction between supply and demand. The par value is just a fixed value or the initial value at which the share was issued at the beginning. After that, the market or the participants in the market through demand and supply, they determine what they think is the fair price of the share, whether it is higher than the par value or lower than the par value. Here, Sarah says, I think the main thing to take into consideration is the intrinsic value of the stock and how efficient the stock market is when deciding to invest. Very good, Sarah. Okay, let's see who of you wants to raise their hands and hear them discussing with us this. Maybe you want, Sarah, to speak more about your, here we have, who is raising hand with me? Yeah. Okay, let's take Vedant.
Hi, so I just want to ask a question related to bonds.
Yeah, go ahead, Vedant.
Yeah, so I want to ask, why would a company choose to issue bonds over stocks? Because issuing stocks won't really cost them anything, but issuing bonds will cost them the interest rate they have to pay.
Yes, very good question. Very good question, Vedant. See, for companies, as I said, it's you have the two options. Like bond is a kind of debt, or they call it financial leverage. So if you issue shares, you are allowing the entrance of more shareholders into your company. Or even if you issue more shares to the existing shareholders, this might cause a dilution of the profits of the company, for example, because now the earnings will be distributed over a bigger number of shares. But using the leverage here, financial leverage, by issuing debt or getting debt, whether from the market, like bonds, or from a bank, it will enable you with the same number of shares to increase your profitability. So sometimes companies would prefer to issue bonds or get loans from the bank rather than issuing or increasing the capital through issuing more shares. Muhammad Al-Mulla wants to say something. Okay, let's have Muhammad. Sorry, Amit first. Amit Malik.
Hi, sir. My question is, I think you have shown the graph. So, but what is the return of last 5 years on the index funds in Qatar?
Okay, let's have this later. I will speak about the exchange traded funds, and let's look at the graphs of the prices. Okay, I will discuss this later.
Sure.
Okay, thank you. Let's take Muhammad now. Muhammad, you can speak now.
Assalamu alaikum.
Alaykum assalam wa rahmatullahi wa barakatuh. Ahlan wa sahlan.
I have a question regarding the bonds. Sometimes you go to a bank and they propose to you that you can go through bonds and with a certain interest which is not secured during the whole year. So 1 year pass, 2 years pass, and you don't get what they promise. For example, they promise 3%, as you said, maybe in your example, but you get 1.5. They say, oh, we couldn't make it 3%, you get 1.5. So is that a right statement, or is that something I misunderstood?
No, Muhammad. No, the thing is that if you are going to the bank and you deposit your money with the bank, it's not bond. Maybe they don't use the right name, because bonds is a security that is issued in the market in something like the IPO. So it's issued for the public by any company, by bank, by government even. So bonds is different than when you deposit your money in the bank. So maybe it's totally different.
Okay. Just because I don't want to give an example of a bank, but sometimes if you go, for example, to HSBC, they can offer you an international bonds.
International bonds, which is
so I don't know if it's the same or something different to what you are speaking about.
Okay, so honestly speaking, for international bonds, mainly I'm speaking here about the bonds that are listed on Qatar Stock Exchange. So, but for international bonds, maybe there are different options in that case. Thank you, Muhammad. Let's take Sarah. Oh, sorry. Sarah, yes.
السلام عليكم أستاذ سامر يعطيك العافية.
Okay, أهلا وسهلا.
أنا سؤالي depending on the risk averseness or the risk profile of the investor could decide on whether he or she would invest in value, income, or growth stocks. But then how would the investor really determine the type of the stock in which he or she is investing in based on the company? Is there a way?
You mean in terms if there's growth or return stock?
Yes.
Of course, from the I will speak more about this in the coming slide or so. But generally speaking, if the company is generous in paying out dividends, then we can consider it as a return stock. If the company is returning the earnings every year and having a growth of their business, they are having more branches opening every year, more expansion locally and internationally, and they are not paying high dividends, then we can consider them a growth company or growth stock. Let's discuss this in the coming few slides.
Thank you.
You're welcome. Thank you, Sarah. Okay, thank you, everyone. And let's move on. With our presentation. So here, the third type of securities, which is very important, and I believe that it is very well recommended to small investors, is the ETFs, or the exchange traded funds. Why it is important for us? Because we always advise the investors and tell them, don't put all the egg in the one basket. Means that you don't put all your money in one stock. Try to diversify and have a portfolio of shares. As if one of the shares is not performing well, other shares or the performance of other shares may compensate this bad performance of the other one. So the thing is, but for individual small investors, it's not easy with small amounts to have a good diversification. A good diversification will need I don't say big amount, but relatively big amount of money. So if I, for example, I have a regular salary that I can save like 10% of my salary or so, which is not very big amount every month, and I want to invest in the stock exchange. I wouldn't recommend to buy directly stocks in the market with this amount of money, small amount of money, but rather you can buy the ETFs units. Why? Because the ETF, it is exchange traded fund. It is a fund managed by a management company licensed by the regulator, and they have the skills, the required skills to follow up the market. They take the money, collect the money. That's why they call it a collective investment scheme. They collect the money from the investors and use this money to construct the portfolio on their behalf. So they go and buy the stocks. So for example, we have a QE ETF, which is a fund or ETF that is tracking or replicating the QE index. The QE index is composed of 20 companies. So the QE ETF is also composed of those 20 companies. So it is a well-diversified portfolio. And you can buy this unit, you can buy 10 units, 1 unit even, according to the amount of money that you have, you can buy the units and you will get this good diversification by the management company. Also, it's easy to track. If the ETF, we say it's a QE ETF, this means that the components of this ETF replicates the components of the index. And the performance of this ETF on a daily basis replicates the performance of the index. So if I every day just have a look at the market and find, for example, today the market increased by 1%, this I can know easily that my investment in the ETF unit has increased also by 1%. I don't need to go and see what is the portfolio or call my broker or check with the fund manager. Alas, it's very easy to track the performance of my investments by tracking the performance of the index that the ETF is replicating. So here we have some points on the chats. Let's take some points here from Saleh. He says, how do we know the fair value of the company? Is it also listed on the stock? Okay, as I said, market is different, price is different than value. So to be able to value the company, of course, it's not easy thing, because it has or requires an element of expectation also. But the thing is that we will have some webinars on financial analysis. If you follow us on these webinars, we will give you also some basic knowledge about how to evaluate a company and try to come up with the fair value of the company. Next week, inshallah. Ramin saying, I think because interest is tax deductible, but dividend is not. Yes. So you are speaking here, Ramin, from the point of view of the company. Yes, this is also one of the reasons that companies might issue bonds instead of shares. But this outside, mainly outside, because yes, it creates what they call a tax shield. Because when you calculate the taxes on the company, you deduct the interest expense before the tax, then it provides the company with a tax shield. Yes, this could be one of the reasons also. Khalid saying bonds is a stable value that is given to you in the beginning. Yes, if you mean number of bonds, yes, number of bonds will be always, if I buy 100 bonds at face value of 100 Qatar Riyal, then I will pay 10,000 Riyals. I will keep the 100 bonds, for example, to the maturity, and by the end of the period, 3 years, 5 years, I go to the company or to the government, I receive back, get back my money, which was the 10,000 Riyals. ETF and mutual fund, same thing. They are the same idea, Salah. They have the same idea. Both of them we call a collective investment scheme. But ETF, in my opinion, is more flexible than mutual funds, because ETF is tracking usually an index. So it's easier for you to know the components on a regular basis, because the index is published over the website, so you know what are the components. It's easy for you also to know the performance by looking at the performance of the index on daily basis, or even during the trading session. It is listed on the stock exchange, so you can at any time buy more or even sell your units easily. It doesn't require that you go to the bank or to the financial institution who created the mutual fund and wait for a certain date until you can redeem your units and so on. So ETF is the same concept, but it's more flexible and easier for the investor. Okay, so let's here continue. This is very important also to discuss tonight, market ratios. What are the most important market ratios that we need to look at when we take our investment decision? So we have here 4 important market ratios that I always say that these are very important to start with. Yes, we have more, but this at least is the basic or the minimum that we need to understand before we enter the market and buy a certain stock. The earnings per share, EPS, the dividends per share, the dividends yield, and the PE ratio, or price to earning ratio. Let me show you an example on the Excel to be able to understand what are those ratios all about. Here, let's look at, we have 2 companies here. Company Y and company Z. Here, let's assume that we are now at the end of the year, 31st of December, and both companies have published their financial statements, including their income statement. Company Y income statement say that the net earnings this year, the bottom line, after deducting all the expenses and every cost, now the net earnings is net profits is 3 million realized by company Y. And here company Z, it's 3.6 million. Who can tell me now on the chat, which company is better than which? So let me have the chat here, sorry for that. Okay, what do you think? Company Y is better or company Z? We have Salah say, or we have an answer say company Z. Most of other answers say company Y. Also, some says company Z. Okay, so we have mixed views here. We don't have like a majority. But let me show you one more issue and then take the same question again. Which is the EPS, or earnings per share. What's the part of earnings that I am, as a shareholder, will get per each share that I hold in this company? Here in company Y, I will get 3 riyals per each share. So if I own 100 shares, so my part of the profits or my share in the profit is 300 riyals. But in company Z, it's 1.8 riyals per share, the EPS, which means that if I own 100 shares, then my EPS or my share in the profits is 180. So in company Y, my share is 300. In company Z, my share is 180. So now after looking at the EPS, our answers changed. Even I can find here some of you have changed their opinion in the chats and saying now company Y is better. Okay, this is when we compare the two companies in terms of EPS. Company Y, yes, is better than company Z. But if I am an investor who am looking for dividends, regular dividends, return, I'm not looking for price appreciation or capital gain over time. I'm looking because, for example, my salary is not enough to finance my daily expenses. So I invested my money like a long time ago in order today to get regular return on my investments that can help me to meet my expenses, my daily expenses. So if we know this piece of information, what do you think? Which is better? Here, company Y decided to pay 30 dirhams or 0.3 riyals per share as dividends, as cash dividends. However, company Z decided to pay 1.2 Qatari riyals per share. So in this case, if I am a return or investor looking for a regular return, then of course company Z is better for me than company Y. But take into consideration very important element here, that companies who are generous in paying dividends, they need to be very cautious for the future. Because the thing is here, which is like very tricky sometimes, let's assume that, let's see how much of the net earnings will be paid by company Y. They, as we said, they will pay 30 dirhams or 0.3 Qatar riyal per share. We have 1 million shares, so they will pay something here, 1 million times 0.3, 300,000 Qatari riyals. So this will be paid out, and the earnings that will be kept with the company as retained earnings is the difference, is 3 million minus the 300,000, it's 2.7 million. On the other side, let's see how much will be kept by company Z and how much will be paid. So the earnings that will be paid by in form of cash dividends by company Z equal the 1.2 per share times the 2 million number of shares is to 2.4 million, and the remaining will be kept with the company as retained earnings equal this 3.6 minus 2.4 give us 1.2. Okay, so here maybe Sarah spoke about this, the difference between return companies and growth companies. Here, this is a good example for this difference. As I mentioned, if I'm an investor looking for dividends, of course, company Z is better for me than company Y. But I should take into consideration another factor here, that company Y, why they keep or why they retain the earnings? Most likely, they have good potential for expansion in the future. They have good projects they need to finance to grow in the future. So instead of issuing new shares, instead of having the burden of a debt by issuing bonds or getting loans from the bank, they can use these profits, these retained earnings, to finance these expansion projects. And this, of course, will help the company to grow in the future. And this growth in the future will benefit the shareholder by reflecting on the share price. So most likely, if this money is used wisely by the company, the share price will increase from 30 to whatever. Here, company Z, most of the money they distributed. So this means what? This means that most likely they don't have plans for expansion, for example. They don't have plans to open. So in this case, most likely the price will not grow in the market like company-wide. So if I am investor who looks for growth companies and I don't need the money right now, I might need it in 10 years' time when I'm retired, then it's better for me to always look at the growth companies. And if I am a person who is already retired, but and I need extra money beside my retirement salary to finance my daily expenses, then I might look at the return companies, something like companies. I'll give you a very famous and very good example that I always mention. There is the best example for growth companies is a company, American company called Berkshire Hathaway. This company, the majority shareholder is Warren Buffett. I'm sure that you know that Warren Buffett they consider him the most successful and the best investor in the world currently. The share of this company back in the 90s, I think in the 90s, yes, it was between 6,000 to 7,000 US dollars. 6,000 to 7,000, which is expensive. The only one share was in the market price 6,000 to 7,000 US dollars. You know what is the price of the share now? It's around 300,000 US dollars. And if I bought 5 shares back in the 90s, I would have retired now very happy. So the thing is that this is a good example for those companies. Not all companies, of course, like Berkshire Hathaway, but it's a good case study for you to be able to understand that if you don't need the money right now, then it's better to invest in growth companies. But if you need the dividends, no, it's better to go and invest in good paying dividends company. So let's now see the third point of today about those market ratios. And here, my question is, which investment option would you choose in example 2? Option 1, which a company that gives you high earnings per share but low dividend, company Y, or option 2, high dividend yield but with low EPS, regular income, companies Z, or mix. Okay, so we have 50 answers right now, so let's share the results. 54% say mix between both, which is a very good strategy. And also, it's good for diversification. 30% potential growth, 15% regular income. This 30% in comparison to 15% suggests that most of you are still young, not old like me. Anyhow, so any one of you wants to give a feedback by voice now, so please raise your hand and let me choose, Vedant again. Let's listen to Vedant's point of view on that. Are you with us, Vedant? Hello? No. So, okay, let's have Muhammad Al-Mullah. Muhammad. Hi, Muhammad. Yeah, go ahead.
So this my question is, if I'm looking into the current market, can you give a real example in the current stock market of a growth company and a dividend company?
Okay, very good point, Muhammad. Let me share now my screen again. Let's have a look at the QSE website and see an example for those companies. But I always try to avoid giving examples with the stocks listed on the Qatar Stock Exchange. Why? Because I don't want you to take it as a recommendation for anything. It's just an example. Because we are giving educational webinars. It's not, the intention here is not to recommend any of the companies, but a good point to have an example, but please keep it in the context of example and not a recommendation. Let me now share my screen with our website, with QSE website. Our website is, qe.com.qa. Let's shift to the English section. Okay, so let us go here. If you want to go to the companies, listed companies, and get information on listed companies, we go to markets, main market, listed companies. And then let's choose a company like QNB. QNB, today's close is 17.9. Here, let's look at QNB earnings per share. The earnings per share for QNB was 1.55 Qatar riyals. So each share or the part of the profits for each share of QNB is 1.55 Qatar riyal. Let's see how much did QNB in their AGM distributed as cash dividends from this 1.55. So if we go here, the AGM of QNB endorses items on its agenda and approves the distribution of 60% cash dividend. Here, 60% means what? 60% of the par value. So here in Qatar, for any listed company, when you hear a percentage as a cash dividends, automatically calculate or multiply this percentage with the par value. And as we agreed, par value is fixed 1 riyal for all. So for QNB, the EPS is 1.55, and the cash dividends, or the part of the dividends that is part of this profits that was distributed or paid for the investors, was 0.6 Qatar riyal, or 60 dirhams for each investor. This suggests what? Suggests that that QNB is always, we consider it as a growth company. Why? Because QNB is like, if you go back 10 years and look at QNB now and compare, you'll find that during those 2 years, QNB had several branches, even not only inside the country, but they expanded outside the country. They have been transferred from a local bank to a regional, and now one of the biggest international banks. So they have in Turkey, they have in Malaysia, they have in Egypt. So they have so many international branches. So they always use their profits or the retained earnings in expansion. Let's look back at a stock like in Mira. Here in Mira and Wuqud also, they are good in dividends, cash dividends. So in Mira, the APS this year was 0.96. 0.96. So it's 90. This means that each share in the profit this year was, or by the end of 2019, this based on the financial statements issued by the end 31st of December 2019. It was 0.96. Let's look also what was the Mira dividends this year. Here in Mira, this is the see, they paid cash dividends 0.85 out of 0.96. Yani, maybe above than more than 90% was paid by Elmira this year to the shareholders in the form of cash. So Elmira is a good example for regular income or return stocks. Okay, so let's go back to our presentation. Here, let's look at most useful 10 investment tips. Of course, you can find so many tips. And of course, as I said, that this tonight is a basic knowledge. Please read more. You will find many sources if you go and surf the internet. Many resources you can find and you can read about the stock. But these are the most important, in my opinion, that first, you need to know your investment goals and strategy. You want to invest for capital gain or for regular dividends or both. Learn about the market and the listed securities. See, here, as I show you, the website of QSE is very rich with information about the listed companies, whether they are like live, so you can follow up the trading session on timely basis during the trading session that starts from 9 to 1:15 in the afternoon every day. You have the market watch, and you can go to the market watch to see the prices and the orders, buy and sell orders, demand and supply on time. And also you have the historical information or historical data, like I showed you regarding the market ratios, the financial statements, and all the information related to each company. Warren Buffett says it's better to buy wonderful company at a fair price. And see here, wonderful company and fair price. Two important factors that come together. You cannot take one and leave the other. Then a fair company at wonderful price. Wonderful company means good selection. Good selection. So you need to take this factor very importantly into consideration, that you don't go and buy any company that you told about by your friends, for example. You need to do a little bit of research using the data available to make sure that this is a good selection, has good fundamentals. The other thing, fair price means what? Good timing. Some people come and say, okay, QNB, for example, is a very good bank, one of the best banks actually in the world. And I bought QNB, but I made losses. Why? Yes, it is good, and it was a good selection, but you didn't look at the other factor. What is the good timing of buying? QNB today at 17.9, maybe it reached 20 and then went down again. So if I buy at 20 and it becomes 17.9, I make losses. So it's important also to have good timing of the market. That's why in the beginning when I said that Charlie Munger said what? We don't make profit when we buy, we don't make profit when we sell, we do make profits when we wait for the good opportunity to buy or sell in the market. Good timing is very important element that you should take it into consideration when you want to buy or to invest your money in the listed securities in the market. In stock markets, this is also very important. Use your savings portion that you don't expect to need in the short term. As I told you before, if your time horizon is only 1 or 2 years, so honestly speaking, shares is not the right investment vehicle for you. As we saw in the first slide, the market index, we always look at maybe 3 to 5 years, if not more. These are the trends that we are looking. So if your time horizon is only 1 year, 2 years, I don't recommend. It's better to have a longer term horizon when you invest in the market, because sometimes there are some crashes, for example, no one can control, like the pandemic. It's something that was like a very surprise and uncertain circumstance that just happened, and all the markets in the world have been affected. So if you are using the portion of your money that you will need now, then you have to sell now in order to get the cash, you will make losses. But if you were using the money that you don't need in the short term, and you can wait, you can wait until the markets bounce back, because it was like very evident, or there was so many empirical evidences that markets going up and down. So if you can wait, then of course markets will recover and the prices will go up again, and you will not make, but you can make profits as well. So define your stop loss point when buying stock. This is also very important. Don't buy stock on hope. Just hope. I buy this stock at 20, I hope it will be 100, and I wait. Also, waiting, yes, is very important, but with another element, taking it into consideration that I have to put a stop loss point at which, okay, halas, I will not wait anymore. I will sell the stock and go and try to find another opportunity, good opportunity to compensate me in my previous losses. So as you can see here, that when you invest in the stock market, don't take only one factor. Don't say that you told me this only. No, you need to have to integrate all these factors together and take it into consideration in order to construct a good investment strategy when you go into the stock market. Right. Don't use all your cash. Keep some cash for making averages when necessary. This is also good. Yani if you use all your cash, then and the price goes down, then it will be yani khalas, nothing to do. You either have to sell if you reach your stop loss point and you realize losses, or you wait, maybe you will wait for a long period of time. But if you have cash on the side, you kept aside, then you can use this cash or part of this cash to buy at the lower price. And this will lower your average cost of acquiring those shares, which will make it cheaper for you. Also, it's good always to diversify. We need to have a portfolio. Regular study and review of your portfolio. What is suitable for your investment today may not be the best for it in the future. Yani, maybe sometimes, for example, today technology or the stocks of the technology company is very booming. If I may say, something like Zoom. Now, if you go and see Zoom 1 year back, the price, its market price, 1 year back and see the market price now, it's booming. So maybe it is now a good time to have a stock like this, but maybe in the future, we will get like other circumstances that make this stock not good, and we need to, from time to time, we need to revisit our portfolio and take out the bad stocks and try to put better stocks, but not on a daily basis, of course, but from time to time. Right. Start investing early as you can, even small amounts. Don't go with the herd. They even say get cautious when people are greedy, when everyone around you is greedy and saying, oh, the market now will be booming and you have to buy now and so on. Get very cautious and get greedy when people are fearful. And you might be able to achieve the best advice in stock markets ever, which says try to buy low and sell high. Let's take poll number 4 now, because I don't want to take much of your time. I don't want to exceed our time limit. So poll number 4 is about the types of investors. What type of investor you think you are? Let's launch the poll and take your views on this one. Okay, so I think we are done now. Share the results. Okay, so we have the majority says I have small savings or regular small income. 22% says I have the time, financial knowledge, trading skills, and big savings. 4% say that I have big savings but don't have other items. Okay, excuse me. So if you are among the 22%, of course, you can go and trade directly into the market. Go now, open an account with the broker, and you trade. But if you are among the 74%, the majority, I would suggest that you consider funds, whether they are mutual funds or exchange traded funds. Inshallah, we will have a webinar next month on exchange traded funds, how they work, what are the advantages they offer for the investors, and so on and so forth. So please follow our social media and website. We'll announce. Until now, it's not known when exactly, but it will be next month about ETFs. So I believe that if you have small savings and you have a regular income that you can build every month, for example, you have a portion that you want to invest out of your savings, this could be a good investment vehicle for you, the ETFs, or in general, the mutual funds. So please attend our webinar on ETFs next month, inshallah. Okay. Well, let's go quickly back and try to cover the rest of it. As I said, risk mitigation is very important to have a portfolio. And don't put all the eggs in the one basket, as we mentioned earlier. I will send you, after the presentation today, I will send you, sorry, I didn't share my screen. Hold on a second, please. Okay. I will share with you our YouTube channel link. Please subscribe to the YouTube channel, QSE YouTube channel. We will, in the next week, inshallah, we will upload the video for the webinar that we had with the Carnegie Mellon University professors about portfolio diversification and how this can help you in risk mitigation. It's very interesting session that I would strongly recommend it to you. So next week, inshallah, if you subscribe and get notification of the channel, you will know when it will be uploaded, and then you can watch it. So, but very simply here, it was proven by a very famous economist in the 50s. His name was Harry Markowitz, and he even got Nobel Prize for this theory, which is called model portfolio management theory. And he has proven that by increasing the number of stocks of your portfolio, you are decreasing a big portion of the unsystematic risk in your portfolio. Of course, there is a portion that cannot be diversified, but also you can, by understanding how this risk works in the stock markets, you can make a good money even in trading this risk by what we call it beta coefficient. And we say that sometimes there are stocks that are aggressive stocks based on their beta calculation, and some stocks that are defensive stocks. Like in a situation, give you very, I think, maybe clear example for every one of us. During the pandemic, there are so many companies globally, even not only in Qatar, they have been negatively impacted big time. And companies that are not that much negatively impacted, and some companies that may be positively impacted by the pandemic. So here, if we are in a situation like this, it's better always to have what we call it defensive stocks with low beta. The beta coefficient is less than 1. Like, for example, food companies, food and beverages companies, Mira, Baladna, and so on, because all of us can, of course, get rid of entertainment, and even cinemas and everything has been closed, but we cannot get rid of food, for example. We still have to buy food and so on. So the effect of market crashes or market situation, bad situation on companies are different. The magnitude of this effect is different. So when the market, they call it bullish market, it's better always to invest more in the aggressive stocks. The beta coefficient more than 1. And when markets are like having like these situations or these uncertain circumstances, it's better to increase our defensive stocks in the portfolio and so on. Please watch the video, and maybe we will have also another webinar on to elaborate more on this with CMU Qatar next month, inshallah. How to open an account? It's very easy. You have two options. You can go to Qatar Central Securities Depository. You as anyone here in Qatar can open an account, whether Qatari or non-Qataris. So everyone is allowed to open account and invest in the Qatar Stock Exchange. There is no restrictions. So to open an account, you might go to Qatar Central Securities Depository, have a depository account, take this depository account and go to any of the brokerage firms listed on our website. We have 8 brokerage firms licensed and regulated by Qatar Stock Exchange and the regulator QFMA. Here, you can go to any of one of them and open a trading account. You can start trading. Or you can go to the broker directly and ask them to open a depository account with QCSD on your behalf, and then they send you a message or something with your trading account. Both is fine. Let's take this poll number 5 also. Regarding trading on the stock market. It's the longest poll today. It's a little bit longer than, it's 4 questions. So it will, when you answer the first question, the second will appear to you and so on and so forth. Okay, so let's give like more 5 seconds and then we end the poll and see the results. Here are the results. So we have a majority that they don't have trading accounts. So I hope after this session, you will open a trading account. Yes, say that those who don't have trading account, they said that they will, yes, go and open an account, 84%. Why, in your opinion, many people are hesitant to trade on the stock market? We have 55% saying stock markets are highly dangerous places and they are afraid of losing money. Here, why, on the other hand, some people find trading in stock market is a good idea. 75% say they have the required knowledge, time, and skill. So, yes, so question number 4, you're answering question number 4 answers how you can not feel that the markets are dangerous in question 3. By knowledge, by gaining knowledge and trying to gain the skills, required skills, you will be able to find the market is interesting place and not a dangerous place to trade. Can I have anyone raise his hand or her hand to get some opinions regarding this poll? Why do you think that trading in stock exchange is dangerous or fun? Here we have a question on the chat, say, Crystal, do you think that you will open the market to let people manage their trading on a stock exchange directly without depending on an approved broker. Honestly speaking, the broker is very important. The broker is very important, and I don't think for the time being, or even in the near future, that markets will get rid of brokers, because brokers are very important for settlement. You know, it is part of the story. Trading on the stock exchange is part of the story. But to continue and complete the story, the buyer need to submit, or the buyer need to deliver the money, or to pay the money, and the seller need to deliver the shares. And who can guarantee this? Of course, the broker is the middleman that can help the depository and the CCP or the clearing companies to guarantee this settlement. So brokers, for the time being, I believe they are very, very important elements of the stock markets, and stock exchanges cannot work without brokers. Okay, so let's just continue for more 5 minutes and then start all the question and answers. Share screen. Here, it's all important to know what are the main types of trading orders. Of course, when you go to the market watch or the market screen, you will find sell orders are called offer in Qatar Stock Exchange. In some other exchanges, they call it ask. Buy order, they call it bid. Bid and offers are divided into three main types: market price order, limited price order, or conditional order. If we speak about market price order is an order without price. So you enter the quantity you want to trade, whether you buy or sell, and you choose market price. And it will be executed very quickly, but the dangerous thing here that you don't have control over the price. It will be executed according to the best counterparty price. But if you have more, if you want to have more control on the price, and you don't want to lose control on your buying or selling price, it's more advisable to enter a limited price order. So you determine the quantity of the shares that you want to buy or sell, plus the price at which you want to buy and sell, to keep always control on the market. And waiting is very, patience is a key virtue. Please don't forget this. Then our trading session, as I said, it starts from 9 to 1:15, but is divided into the following periods. From 9 to 9:30, we call it a pre-opening session. During the pre-opening session, you can enter your trading orders, but there is no execution, no trades executed. Only collecting the system, or the central order book of the system only collects the trading orders from the investors, buyers and sellers, but there is no trading execution. At 9:30, we have the opening auction, which means that at 9:30, the market opens and the system determines all the opening price for all the listed stocks in the market. And you will see the screens, the opening price is determined for all the stock based on the buy and sell, or demand and supply, in the pre-opening session. Then from 9:30 to 1 p.m., there is a continuous trading. You can enter your order, and if your order matches the counterparty order, then a trade will be executed, and you will be notified by your broker that your order is executed. If you want to buy, then you will be notified that the shares are bought. If you want to sell, you will be notified that the shares are sold with the quantity and the price and everything. Pre-closing session, it's from 1 to 10 minutes past 1 p.m. or in the afternoon. And it's the same like pre-opening. System doesn't match orders, no transactions executed, only orders are collected during this 10 minutes period to also determine the closing price, which is determined at the closing auction at 1:10 p.m., 10 past 1 in the afternoon. And then if you want to close your position, for example, you bought 95 shares and you didn't manage to get the 5 more shares, you want to have 100 shares, then you can close your position at the trading at last from 10 past 1 to 15 past 1 in the afternoon. But the execution only happens at the closing price. So there is no auction in this session or these 5 minutes. If you want to execute, you will only execute at the last price or the closing price. Thank you very much. Before taking the questions, I would highly appreciate it if you evaluate this session for me. So you evaluate the material, you evaluate myself in the evaluation this fall. I will launch it. It's like very quick evaluation, 5 questions. This will help us to improve our coming sessions, inshallah. So I will launch the poll. I'll keep it for like 1 or 2 minutes, and then we take all the questions, and hopefully I will be able to answer all of them. Okay, Ahmed has raised his hand. Let's unmute. Now you can speak, Ahmed, if you want to say something. So you raised your hand by mistake, or you want to still say something, Ahmed?
Sorry, you hear me now?
Yes, now I can hear you, of course.
Okay, thank you, sir. Hello, everyone. Please, sir, I want to ask maybe this very specially question. I want to ask about tax, especially tax question about me here. We live here in Europe, so it's okay
if you have a personal question, Ahmed, send me an email, and I will answer your question, inshallah, by email. Okay.
Thanks.
You are most welcome. Thank you.
Thank you. Bye.
Bye. Okay. So now, thank you for your evaluation, and thank you for your time. I will share the results for you now. So thank you very much for your evaluation. I'm happy to feel that you are happy with the webinar. And please, if you have any recommendations for improvement, email it to me, and I will be happy to implement it, inshallah, in coming webinars. Also, if I will send you an email after this session with the PDF document for the PowerPoint presentation and a link to the recording of this session, and also please a link to our YouTube channel to follow any videos, any educational videos posted on the YouTube channel. Now let's take some of your questions based on the time limit that we have. So we have Khalid is saying, is this to be recorded? Inshallah, yes, it is recorded, and I will send you, as I said, Khalid, the link. Here, the resident in Qatar can invest in QSE. Yes, residents in Qatar can invest in all the listed securities in QSE. Syed Hamad Abbas here. How are the figures in the stock market's prices as well as indices adjusted for inflation over time? Inflation, of course, inflation, because you see, stock, any asset in the market is impacted by inflation, of course. So, of course, inflation will have an impact on the stock market prices, and you might find that the stock market prices are increasing by inflation. And sometimes they say that even the increase in the stock market prices cause more inflation because so many people will have good profits. They will liquidate their shares, they will sell and take this cash and money and go and start to increase their consumption. So it is, of course, they are very much related, stock market and inflation. Do you plan to have an ETF to follow the Qatari listed companies? We have two ETF actually on Qatar Stock Exchange. One is following the QE index, which is 20 companies, the most liquid 20 companies. And the other one is following Qatar Stock Exchange Rayyan Sharia Compliant Index. I think it includes 18 to 20 stocks also in this ETF. Since you spoke about ETFs, are they a representation of the economy? When the economy is doing well, will the ETF prices increase too? Generally speaking, the stock exchanges, efficient markets are sometimes they are good mirror for the economy. And of course, all listed securities will follow. But the thing is that sometimes you find that some of the listed securities are overpriced, some are underpriced. So this opened the opportunity for buyers and sellers to interact in the market. Right. Aisha Al-Hajri says, can a company have a market price less than the par value? Yes, we answered this. Yes, of course. Here are shares, Sharia compliant method. We have, as I mentioned, between 18 to 20 shares which are Sharia compliant listed on the stock exchange. Here we have what is the return of ETF in Qatar. The return of ETF in Qatar is always, you can go and see the index. For example, the return, you want to calculate it over a certain period of time. So, for example, if you go and look at the index, QE index, for the last year, you find that there was increase in the index by the end of 2019. Then this means that there was increase in the ETF price, plus the cash dividends, of course, because as I said, the ETF is composed of 20 companies, and those companies, most of them are distributing cash dividends for the shareholders. The ETF in this case is a shareholder in those companies. They collect the cash dividends and then they pay it to the unit holders. Muhammad saying sometimes you go and buy bonds from the banks, but you still don't make profit or loss. Is that right? Honestly speaking, Muhammad, I'm not very aware about the bank bonds, but in our market, in the QSE, in the Qatar Stock Exchange, we have governmental bonds and governmental treasury bills. And all of them, they have fixed rates as interest. Can we sell the bond before the maturity date? Yes, if the bond is listed on the stock exchange, yes, you can sell it at any time. Muhammad Waqa, in your opinion, what amount is relatively big amount to invest? Yeah, there is no big and small amount, Muhammad. It's always, as I said, if you have an amount to enter the market, you can enter the market with any amount now. And then by time, if you have more savings, by time you buy more and you enter more into the market, and then over 1 or 2 years, you will find yourself have a reasonable or a good portfolio, inshallah. Ahmad, what's the hedge fund, mutual fund, ETF? Okay, as I said, ETF is a kind of mutual fund. Mutual funds here are you can find them in the banks. ETFs are funds that are listed on the stock exchange. That's why it's called exchange traded funds. Hedge fund is a totally different story. These are funds that are more for they are trading in risk, in hedging risk. What is the difference between dividends per share and earnings per share? As I mentioned, earnings per share is the part of the profit that is related to each share. So if you want to calculate the earnings per share, you divide the net earnings of the company over the number of share of its capital. But for the dividends per share, not all the share or not all the earnings are distributed. So like in the two examples that we saw, in QNB, they distributed only 60 dirhams out of 1.55 EPS. So the EPS was 1.55 per per share, while the dividends was only 60 dirhams, 0.6. In Almira, the EPS was 0.96, but the distribution or the cash dividends was 0.89. So the dividends are part of the earnings, but the part that is distributed to the shareholders. What is the range when you say small savings? It depends. It depends on you. But I would say like 1,000, 2,000, like the example that I mentioned in the beginning for this fireman. He was like investing $2,000 US, but of course a long time ago, per year. So on a monthly basis, if you can save 1,000 riyals and use this 1,000 riyals to start your investment trip, it would be okay. Do you think you will open the market to let people manage their trading on stock exchange directly without depending on approved broker? As I mentioned, I don't think so. Who are the best brokers in the market? All the brokers on the Qatar Stock Exchange are good brokers with good reputation. All of them are licensed and under supervision and regulation of the regulators, so you can deal with any one of them. It depends on the service that you require. So maybe you will find some brokers that they will offer you with an application to trade online. Maybe others will offer you a trading through call center. So it depends on the services that you require of the broker. You can choose your broker. Difficulty of getting useful information is an obstacle for local market. I don't think it is very difficult because there are so many sources of information in the market, free sources even. The best is the Qatar Stock Exchange website, but I agree totally with you that information is very, very, very important when you invest in the stock exchange. Can a resident who will leave one day Qatar invest in QSE and keep doing it outside? Yes, yes. You can trade on Qatar Stock Exchange from Qatar or from outside Qatar, and we have so many foreigner investors who are residing outside Qatar and trading on the market. Here, let's take some on the chat. What are the documents? This is a very good question. What are the documents required for opening an account? Okay, so the ID is very important. The ID, your ID, I think also a copy of your passport if you are not Qatari. The ID, the residence ID that you have, plus a letter from the bank with your bank account and the IBAN that you want the company to transfer your money to. These are, that's it, nothing else. These are the documents required to open an account. Finally, I would like to thank you very much for attending. It's been 2 hours. So it was very good session. I believe that I enjoyed it with you. So many excellent questions, so many excellent feedback on the chat, and even those of you who gave us a feedback by their voice. Thank you very much for everyone. And I hope that also you enjoyed and you find the session useful. And inshallah, see you in our next webinars, inshallah. Thank you and good night, everyone.